Alright, today we are going to cover the topic aggregate demand and its related concepts. Okay, to begin with the term aggregate demand. This is made up of two words. The word first is demand. Okay, if I ask you what is demand, you will say demand refers to your wishes, your desires, your needs. When you go to the shop, you make a purchase of it and that becomes your demand. Okay, which means any wish, any desire, any want, when it has two characteristics. One, that you have money to purchase it. Second, you are willing to purchase it. Okay, so all of your desires and wants backed by money and willingness to purchase will be called demand. Okay, now coming to first word, which is aggregate. Aggregate refers to collect into whole. Okay, to collect it into whole, which means whenever you total it up, anything which is collected as one whole big thing is called aggregate, and that is why this word aggregate belongs to macroeconomics, and that is why we study this topic in macroeconomics. So after studying both the meaning, we come to this, that aggregate demand refers to total goods and services that are being demanded by all the sectors of an economy. Okay, there are four sectors of economy which will also be covered in component of aggregate demand, don't worry. So total goods and services which all the four sectors of an economy are planning. Please remember that they are planning to purchase them, not the actual demand, but they are planning to purchase it with the given level of income. This is also important, with the given level of income and in an accounting year. Okay, in an accounting year, which means it is calculated over the period of time, and that is why we call it flow concept also. I hope the meaning is clear. Aggregate demand refers to the total demand of goods and services which all the sectors are planning to purchase with the given level of income in an accounting year is called aggregate demand, which means we can say that it is also aggregate expenditure. Whatever they are going to spend in an accounting year will also, which means we can say that aggregate expenditure and aggregate demand are one and the same thing. Important points to remember about aggregate demand, which is also asked in CBSE 2023, that whether aggregate demand is equal to aggregate expenditure. Many students got confused with it because there was some different confusing terminology. So please remember that it had come as MCQ question, and aggregate demand is also called aggregate expenditure and not aggregate consumption, aggregate expenditure. Aggregate demand is not equal to market demand. Okay, market demand, if you remember, we study market demand concept in microeconomics, although AD is macro concept. AD also refers to planned expenditure and not actual, because we study as ex ante and not ex post. AD is a flow concept because it is measured over a period of time, over a component of aggregate demand. As the very first is private household consumption expenditure, which is also represented as C. Okay, what is this? This is called total expenditure incurred by who? Household. Who are households? Households are consumers who are consuming any product without any hope of getting anything in return. Like when we purchase bread, vegetables, fruits. Okay, you purchase a house, you purchase a car, so without anything in return is the hope. Okay, just for your own satisfaction and fulfillment of your demand is called private will be a part of private household consumption expenditure. Now what do you need to remember from this part is that it will be dependent on your disposable income. What is a disposable income? Disposable income refers to the income which is left after paying all the immediate expenses, Okay, what are the immediate expenses? For example, you have to pay rent, you have to pay tax. So this will be called immediate expense. Okay, so whatever income is left with you, for example, if you earn 1 lakh rupees per month, and if you have spent 20, and if you have spent 50,000 rupees on and if you have spent 50,000 rupees on important expenses, what you are left with 50,000, what you are left with 50,000 rupees will become your YD, disposable income. Now, how much amount of goods and services you're going to consume will be dependent on this. If you are left with more, you will consume more. If you are left with less, you'll consume less. And that is why higher the ID, more will be the consumer consumption expenditure. Okay, now next is investment expenditure. Investment expenditure is incurred by private firms. Okay, so what all do we purchase as producer? When if you have a business, what all will you purchase? You will purchase one as capital good. You will invest your money on capital goods. You will purchase machineries, buildings, land and buildings, plant and machinery, or you will spend it on inventory. You will spend it on inventory, which is change in stock. Okay, inventory, which can be the raw material, the semi-finished good, or the finished good if you are a trader. So either you are purchasing capital goods or you are spending it on inventory. Okay, so these are the two things. Now, very important concept to understand here, that while we study aggregate demand, we always take, because we are doing Keynesian economics here, in Keynesian economics we take investment as autonomous. There are two types of investments. First, autonomous investment, and second, induced investment. Okay, let us understand what are these. Autonomous investment refers to, this can be asked for 1 mark or maybe 3 marks as difference. Autonomous investment refers to that part of investment which is very much important for an economy, and it is not dependent on how much economy earns. Okay, which means this is the minimum level of investment. This is the minimum level of investment that a country will have to incur, even if country earns nothing. Okay, for example, there is a situation of COVID wherein people's income might fall, but still they will have to keep on consuming goods and services. So who has responsibility of making it available in the country? The government has responsibility of keeping that minimum level of investment in the country, so that people should get what they cannot afford in a particular given situation. Okay, so this is autonomous level of investment, which we call that remain as independent of income. What is the meaning of independent of income? That it is not dependent on income. So the curve of autonomous investment, if you take income here and if you take investment here, is always drawn as a straight line curve. Wait a minute. Is always drawn as a straight line curve horizontal to x-axis, because it's represent that whatever be the level of income, but if it is 50 crores, it remains 50 crore in the country, whatever people might earn. Okay, and second is the induced investment, which is the opposite of autonomous. Induced investment is very much dependent on income, which means if country economy grows, the investment will increase. If economy will not grow, this will decrease. Okay, so if you are to make the curve for this, you will have this upward sloping curve. Why? Because as income increases, your investment will also keep on increasing. Okay, so you can be asked to draw, you might be given two curves and you are asked to identify which of the following curve is of autonomous investment. So you must remember that autonomous curve will always remain as a constant straight line parallel to x-axis curve, which means it is not dependent on income, although the induced investment will always be dependent on income. More income, more investment, less income, less investment. Then we have third component. What is the third component? Third component is the expenditure done by government. Done by government. How does government spend? Government spend in two ways. Okay, government spend in two ways. As So for example, government purchases certain goods in order to just fulfill the need of consumers. For example, law and order, education. Okay, government is purchasing some medicines and just distributing it in government hospitals. Okay, that becomes government consumption expenditure. That become government consumption expenditure. Although government also spends in other ways, which is called government investment expenditure, wherein government is spent in order to get something as a return. For example, government spends in PSUs. What are PSUs? Public sector undertakings, the government companies, the public sector enterprises. So when government purchases machineries, tools, equipments, lands, building, okay, for these public sector undertakings, it is done in the hope of getting something in return. This is done for profit making. Okay, that is why we call it investment, government investment expenditure. In order to get total government expenditure, we add them both up, which means government consumption expenditure plus government investment expenditure becomes government expenditure, G. Right? Now, what will this be dependent on? This will be dependent on certain things. Whether government is going to spend more or less in the country will be dependent on certain things. For example, how much budget does government have in a particular, how much budget does the government has in a particular year? It will be dependent on it. Okay, whatever budget is allocated towards different areas, the government expenditure will be on the base, will be dependent, the government expenditure will be dependent on that. Moving on to next. Let us recognize the fourth component of aggregate demand. What is the fourth component of aggregate demand? Because in aggregate demand refers to, like I said, aggregate demand refers to aggregate expenditure, whatever is being spent on our goods and services. Okay, so there are two ways in which even expenditure can happen with rest of the world. First, when they are purchasing from us, that is called net export. So suppose they are purchasing goods worth rupees. Suppose they are purchasing goods worth rupees 20 crores. Okay, so this is the export, and they are importing goods worth rupees 100. Okay, goods worth rupees 100. So in this case, you will have net export as 100 positive. Okay, which means we are getting more income because we are selling more to them than purchasing from them. Okay, although if it would be the opposite case, wherein you might be purchasing more, spending less, which means that you are exporting less and you are importing only 200, then you will have minus 100 as net export, which is not good for the economy, which means you are purchasing more than you are selling to them. Okay, now what will this be dependent on? Whether people from outside your country will purchase more from you or less from you will be dependent on what is the rate of exchange that is going on. Okay, the impact of depreciation and appreciation. The impact of depreciation, appreciation. Like we know that whenever there is depreciation of currency, people purchase more from such country wherein depreciation has happened. Okay, so export for such country will always increase. Export for such country will always increase and import for such country will always decrease. Okay, and the impact of appreciation in such manner. Then relative prices of goods and services, which means they will also compare the prices of your goods and services with the other countries' goods and services, since we are now dealing with international market, and international competitiveness plays very important role while consumers are purchasing goods from us. Exchange duties, how much tariff, how much import duties have been imposed by governments, both the countries' governments, the country wherein the goods is getting purchased from, the country where it is being inflowing, and the country where it is coming into. Okay, and the trade policies between the two nations, how much government is in favor of these two trade policies. Okay, so that is what your net exports will be dependent on. So these are the four components which comprises these are the four components which comprise aggregate demand. So can we write here that aggregate demand is how much households are purchasing, household consumption expenditure, how much private companies are purchasing in the form of capital goods and change in inventory, plus how much government is spending as consumer expenditure and investment expenditure, plus what is net export. This is what becomes our component of aggregate demand. Please don't forget, if you are asked to tell the aggregate demand in two sector economy, we only take these two as two sector economy. Okay, so AD in two sector economy model will be somewhat, so AD in two sector economy model will be somewhat like this. Okay, and if you are asked to give it for three sector economy, so then you add AD is equal to C plus I plus G. If you are asked to give it for 4 sector, then you add the last component, which is C plus I plus G plus export minus import, right? Now, let us understand aggregate demand in two sector economy. Since we said that AD is equal to C plus I, okay, C plus I. So we take income from 0 onwards. Consumption is given as this, and investment, which will be autonomous. Autonomous means it will remain same throughout. There will be no change. In Keynesian economics, we take autonomous investment and not induced investment. Okay. So in order to calculate aggregate demand, what will we do? We will add consumption and investment. Okay. So consumption and investment, first level, it is 60. Consumption and investment, 120 plus 20, 140. 120 plus 20, 220. 280 plus 20. So in this way we get AD. Okay. Now let us understand aggregate demand as curve. Okay. Let's take 100, 200, 300, 400. We will take aggregate demand component here, C, consumption and investment. We will take income on x-axis. Okay. So at zero level of income, which is this, your consumption, let's mark them also, 100, 200, 300, 400, 500 and 600. At zero level of income, how much is consumption? 60. Okay. At 100 level of income, it is 140. At 200 level of income, it is 220. At 300 level of income, it is 300. So in this way, you will see that your curve is upward sloping. Your aggregate demand will come as upward sloping, which means the positive slope of aggregate demand. The positive slope of aggregate demand represents how there is positive relationship between income and AD. When income increases, aggregate demand will also increase. When income decreases, aggregate demand will also decrease. Okay.